What's up, traders? Welcome to 2023. I keep getting asked the question, what's going to be the theme for this year? What's going to be the big trade for 2023? I think, and this is just my opinion, which I'm going to express to you all today, bonds are actually going to be the trade of 2023. Big old boring bonds that no one hardly talks about because there's not really typically big YOLO gains to be had, but if you think about the past themes, let's think about the theme of oil back in 2021. Wouldn't you have loved to have gotten into oil back when the price of oil had gone below zero? Oil was not free. It was almost an obvious trade back then. And if you bought oil stocks or if you bought some sort of oil ETF, you would have done very well over the next 2 years. It was a good long term trade from a value proposition. And going into 2023, as I was thinking about my end of year letter, I don't think there's anything quite as depressed other than tech stocks from an asset perspective with nearly the attractive prospect of going back up as bonds. What we're looking at right here is TLT. That's what we're going to use to talk about this trade and express the thesis. And I'm going to go into the thesis. Again, disclaimer, this is my opinion. This is my research I'm sharing to you all so that you can make your own informed decision. But in this process, I want to educate. I want to teach, share why this is the case, why bonds are valued as they are, because this is very important financial information to know. And then how and why I think TLT is going to be the way to express it. Now, interest rates have been going down for the last 15 years, a whole entire generation. And that has affected the valuation of bonds. General rule, as yields go up, bond values go down. As yields go down, bond values go up. Why does that happen? Well, I'm going to talk about that. That is why you see the price of bonds or the price of TLT going down right now, but then also why I think that they are going to go up over the course of this year and possibly into the next. Now, TLT, like I said, is going to be the vehicle that we express this trade with. This is the iShares 20-year Treasury bond ETF. It's made up of Treasury bonds with 20 plus years of maturity. And they're constantly cycling these bonds based on whatever's being issued. This instrument, TLT, in October reached a low of 91.85. It hasn't seen those lows since 2011. This is a more than a decade low. Very good value proposition to buy something at a 10 plus year low. But it's also a very good technical setup. And I'm going to go into that towards the end of the video when we chart out the target. But I do want to go into the reason, the reason that bonds are or have been going down and why I think they are likely to start going up again. So let's talk about this in a time standpoint. Let's go back to this high of TLT, which happened in March of 2020. Now, don't need to tell you, I think, that something was going on in March of 2020 that was making people very, very fearful. And people tend to rush into safety. They rush out of risk assets during fearful times because they don't want to lose their money. And so bonds are typically seen as this safer investment. The reason is because bonds are typically issued in such a way that makes them less risky as, say, equities or any other sort of asset. If a bond is issued by a corporation and something happens to that corporation financially, you'll typically get paid back, depending on the structure, faster than the shareholders will because it's debt. If it's issued by a municipality, this is, say, a city that wants to put in a new sewer line. Well, if the city can't, for some reason, pay off its debts, it can raise taxes. It has that ability, hopefully. And in case of federal treasury bonds, same applies. As a government bond, you're basically taking a bet that the United States government won't default on its debt. And we'll leave opinions about that out. Let's just assume that they won't. So you're considered a safe bet that you're going to get paid back your money. Here's how a bond issuance works. You, as a person has, let's say, a nice even number of $1,000 that you want to lock away. You don't need it right now, but you don't want to leave it under the mattress to be depreciated by inflation. So you're going to go buy a bond with it. You want it to be safe. You don't want it, you want to try to beat inflation, but you want it to be safe. You want it there in 30 years. Let's use that as a maturity date. 30 years from now, that's what you're going to lock it up for. Well, you're going to be given that bond at a coupon rate. And that rate's going to be based on the risk profile of the issuer and also the market rate. Over the course of the last 15 years, as interest rates have been going down, 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 that means that the bond issuances, the coupon rate for bonds has been going down too. They've been very, very low. And up until 2021, they were at the lowest point that they've probably been in over a decade, 15 years even, a generation. But as the Fed has begun raising interest rates, raising that risk-free rate, bonds have had to be issued at a higher rate to match with that rising interest rate. Now, think about it. Let's say that you bought a bond 5 years ago that's paying a coupon rate of 3%, and now you can get a bond with a interest rate of 5%. Which do you want? Do you want the 3% interest rate, or do you want to earn the 5% interest rate? You want to earn more, but you still have this 3% interest rate. You're locked up for 30 years, but there's a secondary market. You can get rid of that 3% bond if you need your money right now, but you're not going to be able to sell it to someone for the same price of your 5% rate. So what do? You have to discount that bond. And that's how bonds are valued. Bonds are valued based on their discounted future cash flow. And we're going to use a calculator to illustrate this to make it a little bit easier to understand. So let's go with a 30-year bond example, years to maturity. The yield or the market rate, let's say at about 3%. That was what we started at a few years ago. Bond face value, make it a nice even $1,000. And the annual coupon rate, because we're living in those depressed times, is about 3%. Let's get this calculated one more time. 3,000. We're going to make this annual. So the bond price to sell to somebody minus commissions is going to be $1,000. It's going to be the par value of that bond, the face value. Well, what happens, as we've seen in the last year, if the market rate goes up? In other words, new bonds are being issued at higher rates to compete with this bond. Well, if we raise the market rate to 4%, then in order to unload this bond, we'd have to sell it at a discount. We'd have to sell this bond at $827 because someone that's taking this on is not going to earn as much as if they bought a brand new bond at 4%. And so we have to discount it. What happens if we go up to a market rate of 5%? We have to discount it even more. We have to only sell it for 692. Let's say that we get up to 6%. Well, we're now down having to sell this bond to get our money back for it at almost half the price. So a difference in interest rates, as interest rates, market rates are going up, is very significant to the value of the bond because it's really a market. It's a competitive market where in order to get someone to buy your 3% bond, you've got to put it on sale for them because they could just go across the street and get a 6% brand new bond for more. Now, what happens if we have one of these 6% bond rates and we start off, there we go. All right, so now you have a bond that's being issued, a new bond for 6%, and rates decrease. Rates go down to 5%. Well, now, because you're earning a higher interest rate on your bond at 6% and the market rate has gone down, you can now sell that bond for more. Your bond value has gone up. Same thing happens if it goes down some more. If you have a 6% coupon rate and the market rate goes down to 4%, you can now sell that bond for a little over $1,300. And if we go down to 3%, well, now you've got almost a 50% premium that you can sell your 6% for because it's going to earn the owner of that bond more interest than they could get otherwise. And so that's why As rates move, so do the value of bonds move because you have to either discount the bond or sell it at a premium based on that expected future cash flow, that discounted future cash flow. That is why you see the bottom fall out of bonds and TLT in December of 2021 onward because the Fed kept raising rates at the fastest point they ever done in history. Now, TLT itself is a traded product. That means that it is subject to the whims and emotions of traders. That means that people are pricing in future movements. And so I am operating under the assumption that what the Fed has said is priced in, but there's a little bit of fear in there. There's a lot of people that I talk to that are a little more FUD, fear, uncertainty, and doubt, that think that we're going to have to go full Paul Volcker. By the way, that was a Fed chairman in the early 80s. He was forced to raise rates up really, really high to combat inflation coming out of the 70s, the stagflation era, which I wasn't alive to remember. And a lot of people don't have in their working memory. You have to find some really older finance people that remember that. I was given an anecdote when I bought my first house that they had paid a 15 or maybe it was 18% interest rate on their mortgage during that time in the early 80s, which is crazy to think, but that was the market then. Here's another anecdote. The highest 30-year fixed rate for treasury bonds, US treasury bonds, was 15.35%. Imagine that. Imagine being someone offering you the opportunity to earn 15.35% on your money for 30 years with zero risk. Imagine that. But believe it or not, people didn't even like that. I remember reading a story, I believe it was in the Market Wizards book, about how when that happened, there was very little interest in those bonds because rates have been going up, 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 up. People assumed that the past would continue into the future. And next month, they would be able to get a bond at 16%, let's say. So, believe it or not, when people were so used to the increasing of interest rates, inflation was such a prominent factor in people's decision making that they didn't even want 15%. A little bit of greed kicked in there. But that was the time period back then and how people were psychologically conditioned. Now, anyone would take 15% risk free. Wow. But in the early 80s, people said no. So times change, but people really don't. So, what you've had over the last 15 years as bond values have gone, interest rates have gone down, you've had bond values go up as these older dated bonds at higher interest rates are having to be marked up to be competitive with new bonds. And then as interest rates have gone up again, yields have gone up, the valuation of the bonds have gone down. And this ETF is made up of a collection of these bonds that they're buying to put into this ETF. And so that's why they've had to discount TLT as it's gone down because the value of these bonds have gone down. But now we're in an interesting situation as we go into 2023. There's basically three things that can possibly happen as we go into 2023. So let's go through those. So, number one, some of the more fearful people I talk to are correct. And the Fed has to raise rates to combat inflation more. They have to increase the rate of rate increases. In other words, they have to go beyond 5.5%. They need to go up to 6, 7, 8, 10%, as some have told me. Well, in that case, then TLT is not undervalued. In fact, TLT will start to go down even more because that means that as rates go up, those existing bonds in TLT are going to be worth even less. So, in the event that the Fed increases the rate of rate increases, TLT goes down. And this trade is wrong. Or the Fed does exactly what it says it does. It raises rates 3 times in 2023, no more, no less. And in that case, all these bonds are going to be added to TLT. I expect TLT to slowly recover. The technicals of this chart begin to play out, and we rise to my target over the next 2 years. Option 3 The Fed finds out, because inflation's coming down, those CPI numbers start to come in lower and lower, that they're actually getting inflation under control, and they can stop raising rates, or they actually start to lower rates. A recession may even factor into this option. So I think in two of the three scenarios for what can happen over the next year, TLT benefits either slowly or bigly. So if number one happens, then this trade is wrong. And what I would expect to happen then is, instead of coming down and holding 100 as it seems to have held at the end of the year 2022, we're going to take out this low in October, and in that case, my risk target is hit, my stop is hit, and this trade is wrong. But if that does not happen, I would be looking for TLT to come up, retrace the 50% of the March 2020 high down to the October 2022 low, somewhere around 130, 135, essentially a 30% increase from 100, which TLT hit at the beginning of this year and the end of 2022. And this sets up a nice 3-to-1 risk reward trade. Now, TLT is a really awesome product in that it is highly liquid. You can either put TLT into your IRA as itself as shares, or it has a very wide option book. There's a lot of options to choose from, and right now implied volatility is still pretty low despite it going down so much. I don't recommend taking really short dated options on this. I personally, I just have the shares of TLT. That's the way my risk profile suits me. But you can try to express this with options trades. Just bear in mind that you need to put a little bit of extra time, go out months, because this is a trade that could take all through 2023 and possibly into 2024 to play out. So bear that in mind. Again, big old boring bonds. This is not your YOLO play. We're not going to go up 1,000%, but I think this is going to be a good high probability trade with some good returns, something to kind of anchor your portfolio going into 2023. And so I hope this helps everyone make a good decision. If you like what you see, like, share, subscribe, do all that metric stuff. I have a Discord, which you're invited to join, that I don't charge for. I just like to share ideas like this with people on a regular basis. I also do Friday live streams. Come out and ask me questions about this. I'm more than happy to talk about it. As always, trade wisely. We'll see you in the next video.